I think Annie,
Okay.
and I think Annie was also part of helping this to get set up today.
Oh, okay. No problem.
Yeah.
Let me. Okay. Okay, Phil. Now you can share the screen.
Very good. Well, good morning, everybody, and welcome. David, thank you for the kind introduction that you just gave me. And welcome to our 1031 exchange meeting today. My goal for you today is to change your life and your future, especially in 2024. In fact, I think we all want to do more in 2024. It even rhymes, right? And the thing is that how do you do more in 24? Interest rates are up. Buyers, there's not too many sellers. Buyers are a little tentative. How do you create new business? And the answer is you're going to have to start working in markets that you've never worked in before. And there are some wonderful markets. If you are a residential person, you don't have to leave residential to be involved with investors, because many investors own investment residential real estate, whether it's one condo or a duplex or a fourplex or a sevenplex or a 12plex. It could be you work with commercial, industrial. The bottom line is even vacant land. All these are different aspects of where you can put in the 1031 exchange. And now we want to talk about what motivates those people. Why did they buy the property in the first place, number one? And number two, what's happened over the years with the equity and how to take the equity to help them make more money. You see, folks, people buy investment property, residential, commercial, industrial, it doesn't matter. They make more monthly income. And the question is, how can you help them? And that's what I want to talk about today. How you can begin to utilize these principles beginning now as we transition into December, which is very close. In fact, the last time I checked, we have 45 or 46 days left in 2023. So now's a good time to prepare yourself to begin to start contacting people who own multiple investment properties who are in a position to sell and buy. And we're going to show you how to do that today. What we're not going to talk about today is giving you tax advice and legal advice. I know that you are not allowed to give tax advice and legal advice. They need to speak to attorneys. They need to speak to CPAs. But what we're going to do today has nothing to do with tax advice. It's about how to help people sell and buy and to make a better, more money and a higher rate of return with the properties they already have. So let's talk about the three things that matters most. Anytime you meet someone who owns property, you would be very wise to discuss what matters most to them. They don't care so much about you and me. They care more about themselves and what's important to them. And I can tell you right now, if they own investment real estate, I know exactly what matters most to them. Number one is monthly income right here. Monthly income is what they want. They get a paycheck each month, a rent check for every front door they own. Doesn't matter if it's an industrial building with one or multiple tenants. It doesn't matter if it's a commercial building or a retail building or a storage facility or a gas station or a car wash. Whatever it happens to be, they want a paycheck from every front door. If it's residential, then if they have a single family, they get one paycheck a month. If they have a 4-unit building, they get 4 paychecks a month. If they have 30 units put together, they get paid every day, every 30 times a month. That's what people want. They want income. Now, income is divided into 2 sections. One section is called cash flow. The other one's called the rate of return. What is cash flow? Cash flow is when you close a sale and you get a commission check. That's cash flow. when they get their rent each month, that's cash flow. The more money that they can generate each month, the better the cash flow would be. The more money they can spend, the more money they can go out and reinvest. That's very important to an investor. But there's a second part of monthly income. It's called rate of return. That's on the right. Rate of return is not like cash flow. It's kind of related to cash flow, but it's completely different. It tells you how hard your property is working for you. And we're going to show you how that works today, so that you may have the opportunity to get in front of people who own multiple properties, who can help you to talk to them about rate of return, not just monthly income in cash flow. That's the number one reason why people buy property. Number one, because it gives you cash flow, monthly income every single month that it's rented. But what's the second most important thing to an investor? The second most important thing to an investor is, excuse me, second thing, my allergies have been going a little crazy lately, but hopefully we can get through this, is appreciation. Appreciation is the second most important thing to an investor, because they buy the property not just to get monthly income, but they want to see the property be worth more money over time. That's how they know they have a good investment. That's what people do when they buy stocks and bonds and mutual funds and REITs in the stock market. They want to see it be worth more over time. Well, real estate is the same way, but the difference between real estate versus stocks and bonds and mutual funds, you get monthly income. You don't with those other ones, and you get higher rate of return. You know, ladies and gentlemen, many people regret that they did not buy more properties 5 years ago, 10 years ago, 15 years ago, 20 years ago, or longer, because each cycle, like the weather we're in now, it's getting cool. It's been very warm lately, but we're beginning to turn the cycle into fall, and then winter will come. Hopefully we'll get rain, but eventually the cycle will change again, the weather cycle, and spring will come back again. The trees will bud, the fruit trees will begin to create new little pieces of fruit that will grow, and in summertime, the full harvest will come in. And then fall will come back again, and then back to winter. Well, it keeps changing. The beautiful thing about investment property, it goes through cycles. It goes up in value, then it comes down a little bit, but then it goes back up higher than it used to be. The biggest regret most of my investors have is that they wish they had bought at least one more or two more properties. Over time, real estate is worth more. Number three, the third motivation is that an investor needs more tax write-off because they're getting paid income on their properties. So guess what the IRS, the United States federal government, and the state of California do to you? They raise your tax rates because you're making more, so they want you to pay more. The more you make, the more they take. That's just the way it works. And the beautiful thing about owning investment real estate is you get to write it off. You get tax deductions on anything you do to the property. You visit the property, you get to write off your mileage. You fix something, you try to rent out an empty unit. Those are all tax deductions. You add new carpet, you paint the property, that's a tax deduction. Something needs to be fixed, it's a tax deduction. If you're going to upgrade the kitchens or the bathrooms, or upgrade the roof, or upgrade the windows into newer, more ecologically solar type windows that will help keep the heat in the wintertime and keep it cooler in the summertime, that's a tax write-off. That is a tax deduction or a capital improvement that you can do to your buildings. And the government lets you write off everything you do to the property. Depreciation is something they give you based on what you pay on the property. So if you bought the property for $500,000 once upon a time, your CPA will break down your $500,000 purchase price into two sections. Land value, what was the land value of the $500,000 building you bought? And what's the building or the capital improvement to the property you bought? Your property is worth two different areas in terms of land and improvement. The land is not depreciable, but the improvement or the building is. And the government will let you write off the value of the building if it's residential for 27.5 years. If it's commercial, they'll let you write it off for 39 years. Why does the government, the IRS, and the state of California let you write it off? Because it reduces the taxes you pay off the incoming rents you collect. The more rents you make, the more they're going to take. But the more deductions you have, including depreciation, reduces the amount of taxes you pay off the rents you collect, so you can keep more of the rents. That's what motivates investment property owners to own property. These three items, monthly income, appreciation, and tax deductions and write-offs, motivate people like my wife and myself, and so many others, maybe a number of you who own rentals. Last time I checked, by the way, of all the people who have the most amount of money or the most successful, how many of them own rental property or commercial buildings? The answer is a lot of them. And the bottom line is that you can grow your portfolio with these three items. You can grow your income with these three items. But the question is, and your clients are going to want to hear from you about this, in the yellow box, how do I get my rentals to work harder? How do I get more out of them? How do I make them work harder for me so I don't have to? Did you get that question? How do I make my buildings work harder for me so I don't have to? I'd like to discuss this with you today. And this is so important and how it's going to relate to the 1031 exchange. The box on the left, the yellow box on the left, talks about growing income, appreciation, and tax write-offs. But the question is, can we look at an example of what that looks like? So let's pretend each one of you that are out there right now, all 14 of you, have two properties. You bought these two properties on the left side. In the red box is property A. In the blue box is property B. These two properties were built in the same year. You bought them and paid the same price for each one of them and closed escrow, let's say 12 years ago. You closed escrow on both of them at the same price that you paid on these two properties 12 years ago. Number two, not only did you pay the same price for them, but these two properties are identical properties. They're the same square footage. They're the same floor plan. They're next door to each other on the same street, and let's say in the city of Arcadia as an example. They're the same lot size. They're in the same condition. There is nothing different about A and B. Nothing except for one thing. If you look on the right side, property A has more equity than property B. Why does A have more equity than B? Maybe you did a refinance on B. Maybe you took some cash out of it. But the bottom line is A has more equity than B. So let's talk about these identical properties with different equity levels as it relates to the three things we just discussed: income, appreciation, and tax write-offs. Let's start with income. We said income has two sides to it. Cash flow, that's what you collect each month. And number two, rate of return. So let's go with the first question. Which property of these two can you make more cash flow on? A, higher equity, lower loan. Or B, lower equity, but higher loan because it has less equity in it. Which property gives you a higher rate of return in terms of cash flow. If you said property A, you're right. Why? Because I have more equity and less debt, I keep more of the rent for myself, which means I spend less money on debt service or paying off loans every single month on A compared to B. B, my loan payments are going to be higher. So I keep more on A and I pay out less on A than I do on B when it comes to debt service. You know, some people say that the American dream is twofold. Number one is to own your own properties, and number two is to pay them off. And that makes total sense if you want cash flow. In fact, when you retire, that's when you should pay off your properties, because you spend money and you work less when you retire. So for example, if you go to Costco, if you go to restaurants, if you go to a grocery store, if you want to travel, if you have to buy a car or put gas in your car and you have to pay insurance and everything that you have to do on a daily and monthly and yearly basis, you need as much cash flow as you can get because you've retired. That's why it makes sense to pay off your primary residence and your buildings, because you get to keep more of the rent, especially on the rentals, that your property can generate. So it makes sense to pay off your rentals after you retire. But which property gives you a higher rate of return off of every dollar you collect on rent? Is it A or is it B? I'd like to show you, because I've got a worksheet to give you today that maybe can help you as you meet with people who own multiple rental properties. How do you calculate what your rate of return is on the equity in A compared to the equity in property B that we just looked at? So I want to talk with you about that. In fact, let me ask you a question. If you were to take the equity out of either one of those buildings and you were to put the money in the bank, the first question you would ask the bank is, what's my interest rate? What's my rate of return if I put 100,000, 10 million, whatever it is in the bank? What are you giving back to me for a rate of return? And that's what everybody wants to know. And that's what we're going to do based on your properties, A versus B, in terms of rate of return. What are you getting back? I want to show you what it looks like. Number one, the gross income you would report on this sheet for every building you own. It might have one single family. It could be a duplex or a fourplex. It could be a 150 unit apartment building. It could be a commercial or industrial that you lease or rent out. So the first question you have to ask is, how much is your gross income every month times 12, so you know what your annual gross income is. Number two, it's not how much you make, it's how much you keep. So you have to calculate your annual expenses. Now, by the way, number one, annual income, and number two, annual expenses, you report, or your client reports, every year on their tax return to the IRS and to the state of California. That's very important. So they know what these numbers are, because they have to, by law, report these. So under annual expenses, everything that you pay, mortgage payments, insurance, property taxes, maintenance, utilities, anything, it doesn't matter. Anything that you spend on this building, like I said, whether you're driving to it or you fix something on it, whatever it happens to be, you get to deduct your expenses. So number one, your gross income, minus number two, your annual expenses, equal number three, your net income. Because like I said, it's not how much you make off of number one, it's how much you keep after your expenses. That's number three, your net income. Number four, what is your net equity in the building? Well, you look at the building, you decide what that building will sell for in all reality. And then to figure out what your net equity is, you subtract what the existing amount of debt against the property is versus what it should sell for. So the sales price minus what is owed on the property equals your net equity. And that would be the answer to number 4. Now, to calculate your property's cash on equity return, this is what you find out. This is what you do. You take the answer to number 3, the net income. You divide it by answer number 4, the net equity. That tells you what your interest rate is on your building. That's what you know your equity is getting back in terms of a return when you consider income and expenses. That's your interest rate. So let's go back to this page. Which property pays you higher, number 1, cash flow versus rate of return? We already determined that A, because it has more equity and less debt, gives you higher cash flow. So question number 2 is, which property gives you a better rate of return when you've performed that formula I just showed you? Is it A, with more equity, or B, the one that's with less equity? The answer is, it's property B. Why? Because the higher the equity goes, the lower the rate of return is going to be on the equity in your building. You said, how can that be? Well, can you charge more rent because you have more equity in A? Can A charge more rent than B can? Can't. They're identical buildings, folks. They're the same identical buildings next door to each other. We already said that. Same square footage, same year built, same lot size. They're next door to each other. They're going to rent for not how much equity is in the building. They're going to rent for how much a building like that would rent for, fair market value. And they're going to be identical. So the equity in B, which is far less, can earn the same amount of rent that A can. So the bottom line is, the higher the equity, the lower the rate of return, unless you're going to retire. That's when you want to pay both A and B off. So the higher rate of return property is going to be B almost every single time. Number 2, let's talk about appreciation. Which property will appreciate faster, the one with more equity or the one with less equity? The answer is, they're going to appreciate the same amount because they're identical buildings. You don't appreciate more because you have more equity. You appreciate because of the kind of building these are. And these are identical buildings next door to each other. So when the market goes up, they're going to go up the same amount. So guess which equity is working harder for you when it comes to appreciation growth? The answer is B is. Because A has more equity and it can't get more appreciation because it has more equity. Number 3, which property will give you better tax write-offs? The answer is probably B. Why? Because they're identical properties. They're going to have pretty close to the same amount of tax write-offs, except B has something more than A does, mortgage debt. But guess what happens with mortgage debt? You get to write it off. When the interest rates go up, you have more to write off because you have to spend more in interest. So guess what happens? Your rate of return goes up higher on B because it has more debt, which means I have more to write off, which means I pay less to the IRS and to the California Franchise Tax Board when I do my tax returns every single year. That's why releveraging makes sense. What's releveraging? It's taking equity out of A to buy more properties, so I have more front doors that are going to pay me rent. I have more properties that when it begins to appreciate, the market goes up again, it's going to go up with multiple properties. And number 3, when I have more deductions because I've releveraged and I have more debt. Again, you pay it off when you retire, after you retire. But before that, you should be doing what? re-leveraging the equity so you have more to appreciate with, more properties to pay you rent. And that's how it works. When I sell the building, whatever the sales price is, and in this example, we're going to use $1 million minus what you paid for it. And what you paid for it is called your adjusted basis, but it isn't just what you paid for it. If you add capital improvements into the building, it raises what you paid for it. So the basis goes up. If it's a rental or a business use property and I'm depreciating it, because you can't depreciate your primary residence or your second home or your vacation home, then guess what? Then depreciation brings it down. At the end, when I sell the property, there are closing costs I have to pay. There are things I might have to fix. I have to pay commissions and escrow and title insurance and transfer taxes and recording fees and 1031 exchange fees. All that have to be factored in to the number 2 adjusted basis. So at the end of the day, when you close escrow, the CPA is going to take the $1 million of sales price, subtract whatever the adjusted basis is. The difference has nothing to do with equity in the building, is your capital gain. So the question is, how much tax do you pay off your capital gain? Well, if it's your primary residence and you're married and you've lived in it for at least 2 years, then the government gives up to $500,000 of capital gain exclusion. What is that called? It's called the primary residence 121 principal residence exclusion, where you get up to $500,000 off your $700,000 gain, which means now your gain is only $200,000. Or if you're single, you get up to $250,000 of your capital gain off the $700,000, which now you pay taxes on $450,000 as opposed to $200,000 because you're single versus married. If it's a second home or a vacation home, you pay 100% of the tax on the $700,000. Second homes and vacation homes do not get up to $500,000 on the principal residence exclusion. If it's a rental property and you don't do a 1031 exchange, you pay all the taxes on the $700,000. What do taxes today look like on your capital gains? There's 4 taxes you pay when you sell property. Number one, you pay the long-term IRS capital gains taxes. Today, that tax, depending on your tax bracket, is between 15 and 20% of the gain you just looked at the last page. Number 2, if your gain is over $200,000, you pay the Obamacare or the health care or the Medicare tax. That's when they introduced, the universal health care for the United States. Well, it's not free. People who sell property have to contribute in it if their sale is $250,000, or if their gain is $250,000 or greater. Number 3, you have that. By the way, that applies to your principal residence, the health care tax as well. Number 3, you have to pay tax to the state of California. California is very low on revenues right now. In fact, we're broke. We have no money saved in our coffers in California. We used to have $1 billion in revenue and not in revenue, but in assets. It's all gone. California is the #1 tax state in the United States. Currently, our tax rates are between 9.3 and 13.3%. Unfortunately, there is a good chance that California might raise the state tax, which is already the highest in the land, from 13.3 to between 16 and 18.3%. Lastly, if it's a rental property, you've been able to take the depreciation. We just spoke about that just a few minutes ago. When you sell the property, the government makes you pay a 25% tax on all the depreciation you are allowed to deduct. Again, it's only for an investment property, whether it's a business use or a rental. Now, if you didn't take the depreciation, you still have to pay the 25% tax on the depreciation they allowed you to take, whether you took it or not. It's crazy, but that's how it works. Those are the 4 taxes you pay when you sell a piece of rental property. So what's a 1031 tax deferred exchange? It's an investment sale and purchase, an investment property, real estate sale and purchase, allowing the real estate investor to defer the capital gains tax. It's a tax deferred exchange. It's not a tax-free exchange. You don't get the money tax-free. They just allow you to not pay the tax, to take the gain with you. So you can buy bigger, better property and re-leverage, so you have more doors to pay you more income. So you have more appreciation when value goes up, because now you have more buildings or bigger buildings in better areas. And number 3, you have more tax write-offs when you're buying up, because you're creating additional depreciation. Folks, investors, instead of paying the 25 or 28 to 30 to 50% taxes, will do this exchange to keep the tax money and reinvest it into their buildings. And that's all a 1031 exchange is. Well, you eventually pay the tax if you keep deferring it. Yes, if you later sell and not do another exchange. Again, they don't go back to your last property. They go back to your first property that you began initiating the exchange, whatever the basis is. And the sales price, like we showed you before, minus the basis that you brought from the very first property, which is going to be huge, you pay all those taxes on. So the question is, why would you cash out? You would just go into better properties for yourself that will pay you income. And if you have your property in a trust, as an example, and you pass away, then your heirs, whether it's your spouse, your children, or grandchildren, whoever they happen to be, receive the property not at your $300,000 basis that you originally bought for. They receive it at a stepped up basis. Stepped up, what does that mean? Well, whatever the fair market value was of your property or properties, it goes to that fair market value the day you died. Which means if you bought it originally for $300,000 and now you're sitting on $5 million of property, your family will inherit the property at $5 million. So if they turn around and sell the property 2 months later, they pay nothing in taxes because there's no gain anymore. There's no capital gain. And the taxes are based on your capital gain. And that's what a stepped up basis is. Your clients need to consult their tax professional or estate planning attorney, especially an estate planning attorney who can create a trust. Or if they have LLCs, the trust can be the owner, the shareholder of the LLCs. So it steps up everything when they pass. It's a great exit plan. It's a great estate plan. So which properties qualify for the 1031 exchange? There's only 3. They're all under the heading of the first one on the left, investment real estate only. But to qualify what only means, you have to have had it as investment real estate for the last 2 years or farther back. What kinds of properties the last 2 years or farther back can I use as a 1031 exchange? Number 1, rental, held for income. So if you've been charging rent on your units or your commercial building or your residential, whatever happens to be, the government says you can do a 1031 exchange out of that property into other investment property. Or number 2, if it's held for your business, it's like a warehouse or a factory or an office building or whatever it happens to be, the government allows you to do a 1031 exchange on it as long as you've been utilizing it for at least 2 years or longer in your business. Or number 3, believe it or not, vacant land. Vacant land, you don't run a business out of it usually. Number 2, you don't typically charge rent on vacant land, but the government feels that you can own vacant land for appreciation purposes. Therefore, vacant land is exchangeable. These are the only 3 properties that qualify. It has nothing to do, please hear this, It has nothing to do whether it's residential or commercial or industrial. It has nothing to do with any of that. It just says it's property that either you've rented out for the last 2 years, or you've utilized in your business for the last 2 years, or it's vacant land that you've owned for at least the last 2 years or longer. So it has to be a like-kind exchange. But what does that mean? Does that mean if I'm selling a residential building, I got to go back into a residential building? It doesn't mean that at all. It means if you're selling what's qualified as investment real estate on this page, and you go back to any of these investment properties, it doesn't matter if you're going from residential to commercial or commercial to residential. You can exchange into any kind of property you're going to put into service as investment, as long as you're selling investment anywhere in the country. So you can sell in California, and you can buy in states like Arizona or Nevada, Tennessee, North Carolina, South Carolina, Texas, Oklahoma, Colorado, places like Idaho, Montana, Ohio. Folks are moving their properties here in California, and 25% of them are leaving the state because the other states are a little more fair the way they treat the landlord, the person who owns the investment property. They treat them more fairly. But here in California, they don't. They tend to give the favor to the tenant and not the owner. They put all the burden on the owner and less on the tenant. Therefore, a lot of investors want out of California. Another reason why investors are leaving California is because they tax too high in California. It's too excessive. It's too overburdening for investors. So they're taking their investment properties and going to other places where they can get better rates of return, and they utilize a like-kind 1031 tax deferred exchange to move their properties around. So which properties do not qualify or are not eligible for your 1031 exchange? Your primary residence. It's never eligible because it's not a rental and you're not using it for your business. Your second home, your vacation home, a business, not the property. The property that your business in can be exchanged, but not the business itself, not the equity of the business, not the goodwill of the business, not the inventory of the business, not the equipment of the business. Just the property is allowed. Therefore, the business is not. Flipping and developing, generally speaking, are not qualified because you never rented the property for 2 years. You never moved into the property to run a business on it. You just simply built it and sold it. So what does qualify? Any investment property. So what happens if you have a 4-unit apartment building and you live in 1 unit, your client does, but they rent out the other 3? Well, the government will let you split it. They will let the principal residence be under the principal residence exclusion, up to 250 or up to 500,000 if they qualify for it. And the other 3 units that have been rented, they can do a 1031 exchange on the value of that fourplex. It could be a single family with an ADU on the back. Whatever, as long as it qualifies, it can be exchanged, that part of the property. So let's pass this stuff. How do you set up a 1031 exchange? First thing you talk to with your investors is, have you thought about, and they have a tenant in the property. First question is, why are you selling? And are you planning to reinvest money into a replacement property? And if they say yes, then tell them to talk to their CPA to confirm that a 1031 exchange is a good deal for them. So now they don't have to pay the taxes to sell. Next, number 2, when you do a 1031 exchange, you have to hire an accommodator or a qualified intermediary. That's what companies like ours do. We set up, while it's an escrow, the 1031 exchange on the sale of the property. So 2 things you got to know. Number 1, in red on the bottom, the exchange must be set up by a facilitator, companies like ours, while the escrow is opened before the escrow closes. Ladies and gentlemen, you know how many calls I get every single week where people call me up and say, I need to do a 1031 exchange, but I've already closed my sale. Is it too late? The answer is yes, it is. The government will not allow you to do a 1031 exchange after the sale closes. Number two, when you take the listing, you want to put in the seller's doing an exchange inside your agent's remarks in your MLS listing. The seller's doing an exchange, the buyer to cooperate and no cost to the buyer. But your RPA, you should use the CAR zip form right here. You see it right in front of you. It's called the seller's intent to exchange addendum. It's called the SXA form. This is your form. The CAR wants you to use your form. It brings the accommodator in, and in number 4, you can actually request extensions to the sale closing if you need more time to find a new property. We'll get into that in just a minute. And when you go to buy, you use the buyer's intent to exchange. It's the BXA addendum form. It's the one right in front of you right now. I'm not sure if there are any questions at this point. I'll keep talking, I guess. And the bottom line is, if you have any questions in the chat box, you're welcome to either type it in, or at the end, you can ask questions and we can answer all your questions. Because we have a limitation on how much time we could spend today, we can't talk about all the different kinds of exchanges. But there are 2 of all of these exchanges that are utilized the most. In fact, they're probably utilized about 85% of all 1031 exchanges out there. And those are the ones I want to talk about today. Number 1 is called the delayed exchange. What is a delayed exchange? A delayed exchange says you're going to set up your sale. You're going to set us up with the escrow company as the accommodator, and then you're going to close your sale first. The sale closes first. At the day of closing, the government says you have 180 days to close escrow on your new purchase from the time the sale closes. So today is November the 15th. So if we close escrow today on the rental, as long as we've set up the exchange documents with a company like ours, for example, who's an accommodator, beginning the close of today, with tomorrow being day 1, you have 180 days to close escrow on a replacement property that you're going to re-leverage in, that we just talked about, another rental or business use property or vacant land, any investment property. You have 180 days to close. Now, it's very important. 180 days is not 6 months. It's 180 calendar days. It's about 3 days less than 6 months, roughly. Different years, it's a little different because of things like leap year and whatnot. That's number 1. So you can close within 180 days. That's fine. Most people can make that deadline. That's usually not a problem. But the second requirement on a delayed exchange is very difficult. You only have 45 days from the time you close escrow. 45 days, the first 45 days of the 180 days to close. You must name the address of the property you're going to buy within the first 45 days. How many properties could I name on my list of possibilities to acquire this identification? The answer is 3. Under the 3 property rule, the government will allow you to name up to 3 replacement properties. You can buy any one of those 3. You can buy all 3. It's up to you. You can buy 2 of the 3. The goal is to buy for equal or greater, like we're going to be talking about in just a minute. But you can buy up to 3 different properties under the 3 property rule. There's another rule. We'll talk about that another time. Doesn't really apply to most people who are selling and buying in the big city. They're not going to buy 4 or 5 or 10 buildings. There's a rule for that, but we won't get into that today. This is very important. Now, can I change my list of 3 properties? Yes. How many times? As many times as you like, but not after day 45. That's the last day you have to either submit your identification of up to 3 properties or come up with the last change where you pull some properties off and you put new properties in. And those are the only properties that you can choose from. Whatever's left on your list at the end of day 45. That's called a delayed exchange. There's a second exchange that's also used, not quite as much as a delayed exchange, but in markets like today, where there's not a lot of inventory, it's called a reverse exchange. A reverse exchange, the government will allow you to close escrow on what you want to buy first. So you have to include your accommodator. We have to set up a holding corporation that's going to take title to your new purchase. And from the time we take title to your new purchase, you have 180 days to take title to that property we're holding for you. And you must close your sale, because you're closing your purchase first, within 180 days. So that's how it works. The reverse exchange is basically, I'm going to close a purchase first and then a sale. Either way, whether you use the delayed exchange, close the sale first and then the purchase, or the reverse exchange, if you're going to close the purchase first and then the sale within the 180 days, you have to have a company who is specializing as an accommodator, as a qualified intermediary, to set up either one of those that are going to be better for you. In some cases, you could actually do both, but we won't get into that today because we don't have enough time to talk about that. Let's pass these other types of exchanges that we have. This next part is very important. I've got two parts to go over and we'll be done for today. The first one is, what is the minimum I could buy my new properties for? Because if I sold for $1 million, as an example, how much do I have to buy? How much cash can I keep? Can I reimburse myself for expenses to the property or the original down payment that I put in, a bunch of years ago when I bought it? I want to go over the two rules that you must know. Number one, all the cash from the sale of your first property that you're selling must go into the purchase of the new property. Reverse exchange, you do it backwards, but the bottom line is you can't really touch cash. You're supposed to change properties. So you're not allowed to personally take cash. So all the cash from the sale must go into the purchase. Number two, if you're paying off a loan on the property you're selling, you have to reborrow the loan. See, for you to go equal or greater in value, you can't just replace the cash. You have to reborrow the mortgage. And I'm going to show you how that works in just a minute. The government will allow you from your sale to take out of the proceeds of the sale the one-time costs to sell. Those are called the non-recurring allowable costs to sell. What does that look like? Commissions. You have to pay commissions, or the seller is going to pay you commissions. That is allowed to come out of your proceeds of your sale. Number two, they have to pay the escrow company. Number three, they have to pay the title company so the seller can provide a policy of title insurance for the buyer. Number four, they have to pay transfer tax. Los Angeles County and every county in California charges a tax of transfer when you sell a piece of property. It's $1.10 for every $1,000 of sales price that you sell for. Next, some cities charge a transfer tax. And if those cities do, you have to pay for that in the sale, but you can pay for it out of the proceeds of your sale because it's a one-time cost to sell. What are other one-time costs to sell? Your recording fees. Your document's going to be recorded at the county recorder. That is allowable as a cost of sale. My fees, if you're doing a 1031 exchange, those fees are a one-time cost to sell. Lastly, any agreement between the seller and buyer that is contractual. In other words, it's written out on the contract that the seller will reimburse the buyer for expenses or repairs that have to be made, or the seller will pay for expenses up front before the escrow closes so that all the repairs can be made. That is a negotiable instrument. And you could pay for that because it's a one-time cost to sell to perform these items for the buyer. All this is allowable to come out of the proceeds. So if we sold a property for $1 million, that's item number one, but our cost of sale, our non-recurring cost of sale is, let's say, 7%, so we'll call it 70,000. That leaves you a balance of number three of $930,000. Your new price of your new property must be at least 930 or more. In any situation, 930 or more if these are the numbers. Because equal or greater of $1 million is not $1 million. It's the sale price minus the one-time non-recurring cost of sale. But if you do have a loan or multiple loans on your properties, a first deed of trust, a second deed of trust, a HELOC, a line of credit, hard money, whatever it happens to be, those can be paid off at the close of the sale. The title company does that. So what happens? Well, 930,000 that's left over after non-recurring closing costs minus all your loans equals of 400,000 equals number five, $530,000, because 930 minus 400 is 530, right? All the 530 that we're holding must go into the purchase, all of it. Remember, we just said a minute ago, you have to replace all the cash, but if you're paying off any mortgage, you still have to go back up to 930. So how do you go to 930 from 530 of cash that you have left over after your sale? The answer is you must reborrow the $400,000 so you can get back up to $930,000. Whether you're buying one property or if you're buying two or three properties, you can split it up any way you'd like amongst the one property you buy, the two property you buy, the three properties you buy anywhere in the United States, as long as they're what? Investment properties, like we just said. You can't keep cash for reimbursing yourself, preparing the property for sale. You can't overborrow on the purchase, have the lender overfund it, and then you get all the cash back. If you do, you pay taxes on the money. The exchanger, please get this part, is not allowed to touch money. It's only allowed to trade real estate through a sale to one party and a purchase from another. Be careful. How you replace a loan? Very simple. You reborrow with another lender. You bring in new cash. If you don't want a loan, the government says go and get cash out one of your CDs or whatever, wherever you have the money. Put that new money into the new purchase before escrow closes. Now you're replacing the loan for $400,000 with new cash of $400,000 or greater, so you don't have to reborrow because you're replacing the loan with new money. The seller can carry back for you. You could assume the seller's loan, or any combination of any of the above is good loan or debt replacement. We will move the earnest money deposit into the acquisition. We will protect the funds while we're holding it in between. We don't commingle the money. We put it in a single client trust account at the bank where it's safe, where it's insured by the bank, where there's bonding and errors and omissions insurance. They will never be put into a corporate account. Folks, not every company does this. A lot of them cut back because it costs them money to do it this way. But it's the safest way to protect your client's money. Even if the money, when it's time for the money to leave the account, the client has to sign an authorization so they know exactly where their money is 100% of the time. There's bonding on the money, errors and omissions insurance, there's attorneys on staff. That we have to protect your client. We have to protect your money. If you don't use our company, that's fine. There are some very good companies out there, but you have to make sure they're doing exactly what you see written in front of you now. That's why you should probably take a picture of this page. If they're not doing this, go to a different company that does. We'll take care of you. It's just important that the client is protected in a 1031 exchange. You can't go into other things that are not considered investment properties. There's lots of things that we just don't have time to talk about right now. Maybe if we come back another time and talk a little bit more about the advanced items, we can go over pages like this. But you have to make sure it's a qualified exchange. It goes into qualified investment property, like we've been discussing today. Can LLCs do a 1031 exchange? Yes. Can corporations do an exchange? Absolutely. A trust? No doubt. Limited partnership? Absolutely. Individuals? Yes. Does the ownership have to stay the same? Yes. The seller and the buyer have to be the same tax-paying party. Remember, you're not a name, you're a tax identification number. You're either a social security number that owns your property, or you're an EIN number, or you're a EIN or TIN number. So remember, sometimes the name can change a little bit, but it's the tax number that has to be the seller, and that same tax number that's sold has to be the buyer. That's a 1031 exchange. You can't buy it to move into it. You have to buy it to hold and rent out. There's a lot of things we have to pass because we're running out of time here, but I want to get to the end of our presentation by doing two things: answering questions, and I'm going to give you an offer today. Here's the offer. I have 20 different marketing letters that talk about a lot of what we just discussed today. If you want to be different in 24 than you were in 23, you need to have new people to talk with. People who own properties. Investors own a lot of property. Some of them only own 1 or 2 or 3, but many of them is 4 or 5 or 10 or 15 or 20 or 30 or 40. These people own these properties. How do you find out who owns the properties? Talk to Annie. She'll help you. She'll get you a farm package of all the people who own rental properties 12 years or longer. But we do qualify 12 years or longer. Why? Because the more equity they have, the lower the rate of return is. And these people are prime. They're perfect for a 1031 tax deferred exchange, to sell and to buy in a 1031. Well, it sounds like the rain is starting to come down. So finally, all the rain that we're talking about is finally coming outside. I will give you these letters that talk about all these different aspects of the 1031 exchange. In fact, I'm going to close the window here so you don't hear all the rain noise. There it goes. It's a little better. So the bottom line is, I'll provide you the letters if you want them, if you promise to use them. If you're not going to use them, it's a waste of time for you to even send me an email requesting the letters. So it will include things like what your rate of return is and how to calculate it. And I just want to say, David, thank you so much for allowing us to speak with your agents today, to give them a vision for 2024 so they could have more in 24, more clients, more escrows, more closings, more buying replacement property. The beautiful thing about doing a 1031 exchange, you have to do a sale and a purchase. It isn't just one, it's both. If you want those letters, my email address is on the below in philatwan@gmail.com. Take a picture of it, send me an email, request the letters. I will give them to you. I won't charge you for them, but I expect you to use them. If you will use them, you will create over time new business. If you have a 1031 exchange question, or you need me to speak to your client, or you want to do a 3-way call with your client, I'm happy to help you. That's my phone number, 213-479-8800. But thank you for the opportunity, to speak and educate you today. Are there any questions that I can answer, David, that are either in the chat room or somebody would like to unmute themselves and start asking questions? Either way, I'm happy to do it.
Yes. Thanks again, Phil, for bringing us such a wonderful lectures. And if you have any questions, please feel free to unmute and ask them by yourself. Michael, I saw you unmute yourself.
Yeah. Hi, Phil. How are you?
Hi, Michael. Good to talk with
Hi,
you.
hey, yeah, very good to see you.
Thank you.
I see you a lot on Facebook sometimes during
Yeah.
the baseball season. Anyway,
That's right. Go Dodgers.
yeah, I know, huh? This year, yeah.
Yeah,
Otani
let's not
maybe.
talk about this year.
Okay. Anyway, so the now the 180 days, right? I know we have 180 days to close this escrow, the new property. What if we don't? For some reason, there's a delay. Can we extend the 180 days?
No, unfortunately, Michael, the government will not allow you. You have to stay within the 45 days of identification
Right.
and 180 days to close, and both periods begin at the date of the closing of the sale. That's why you want to use that seller's intent to exchange addendum zip form that I showed you. So you can put in language to negotiate an extension to the closing date if you need more time to find property and to close.
Oh, so there's a form. I'm sorry, I missed that part. Yeah.
Yeah. You want me to go back to it real quick?
Yeah, please.
Let me go back to it really quick here.
Okay, thank you. Yeah,
You're
I missed
welcome.
that one.
No problem. It's my pleasure. Right here. This is called the seller.
Oh, okay.
Buyer. There's two of them. There's the seller's intent to
Oh,
exchange,
okay, great.
and then there's a buyer's intent to exchange. When you take the listing, you want to talk to the seller as to how much time they need to extend. Under item number 4, you can do contingency language that allows you to extend escrow how many days that you want to. 15 days,
Oh, okay.
30 days, 60 days, 90 days, because, and you will release the contingency once you go into escrow on a new property that you approve, let's say, an inspection report, inspection. All that will help you in terms of making your job, the client's job, easier, so they have enough time to find what they need to buy.
So
once close it too.
Yeah. Sorry about that, Phil. So if they agree, if the seller agrees to sign this, then we're good, right? Basically.
Perfectly good. Or you can negotiate it. You know, maybe you're asking for 90 days and they'll settle for 45 days extension to whatever amount of time you're supposed to go close escrow on. Any extra time you get is going to help your
right. So thank you so much.
Anytime. It's always good to see you.
Yeah,
it's always
same
good to hear your voice.
Always very good to listen to an expert like you. I know you.
I'm honored to be here. Thank you for saying such kind words.
Thank you so much. Yeah, I know you for so many years, so
yes.
I know you're pro. Going back to the short sale days, I know.
Yes, I remember those.
So long. Yeah, thank you.
You're welcome.
Yeah, thanks so much, Phil.
You're welcome. David, anybody else would like to ask a question or?
Yeah, anyone have another questions? So you can text on the chat box or you can unmute yourself. Yeah, we know the fields mentioned today's many key points. So we can persuade the investment owners to sell their property with the 1031 exchange to save tax, or maybe they can until to hold the properties at the end. So maybe they can have the tax-free, right? So I think another very important things, if you have any clients want to do 1031 exchange or they need to consulting the experts, please remember to contact with the fields. I think the field can really help you to talk with your client, explains any 1031 exchange the questions. Yeah. So yeah, if no one have any questions, yeah.
Oh, I'm sorry, David.
Okay, Michael.
I have one more.
Yes, sir,
Phil,
Michael.
yeah, I'm sorry.
No problem.
So you talk about the 12 years. Basically that's the year we should be targeting, right? The seller that own the property for 12 years.
Some agents like 10 years, they feel like that's enough equity to justify releveraging. Some say 12 years is a little bit more equity, so that definitely makes it more worthwhile to releverage. I think it's important to make sure that they have good equity to be able to releverage into better property so they can have more front doors that'll pay them rent and better rent checks.
Okay. So 10 to between 10 to 12 years, right?
Minimum,
Those are
yeah,
the
minimum.
windows.
Correct,
Okay.
or anything above that.
Okay, yeah. Thank you. Thank you again, Phil.
My pleasure, Michael,
Appreciate it.
anytime.
Yeah, thank you.
And David, thank you to you and your staff, Annie Fan, who made this happen today. And I wish you all the happy Thanksgiving. We have so much to be thankful and grateful for, so many opportunities, so many people that we love in our families. It's a good time to be grateful and thankful and look forward to 2024.
Yes, yeah, we all know this year's maybe the real estate market up and down, right? So maybe we can use the 1031 exchange, the really useful and great the tools to help our clients to sell their property and get more valuable properties, and also so we can make more money for this year and next years. Yeah. Okay. Thank you.
Thank you.
Okay.
Thank
Phil.
you.
Yeah.
Thank you.
Thank
Have a
you.
good day, everyone.
Thank you.
Thank you very
Bye.
much.
Take care.
Thank you.
Bye-bye.
Bye-bye. Thank you.
Take care. Bye-bye.
Take
Thank
care.
you.